Thank you. Good morning. It's a pleasure to be here, Steve. Thank you very much. Looking forward to more or less the second half of the year. Where are we? What's up? I'm reasonably optimistic. I wouldn't say I'm bouncing off the walls with optimism, but I'm pretty optimistic. And there are 4 or 5 general reasons why I'm feeling pretty good. At least certainly over the long haul, and saying we're not going to go into recession and so on and so forth. So the first reason I'm pretty happy is households have done a tremendously good job fixing up their balance sheets. 4, 5, 6 years ago, we had a lot of debt on the household side. It's really disappeared largely. And no matter how you measure it, households are doing better. One good measure of this is looking at what percentage of households who refi shorten or lengthen the life of the mortgage they've got. And they've been reducing them quite substantially. The number of households now that refi and reduce the length of mortgage is up to 27%. It was close to 10% at the boom in 06 or 07. But conversely, the number of ones who are making a longer term has declined to 4 or 5% from 20 or 30%. So households are becoming much more conservative. Now, on one hand, this is delaying our recovery. But on the other hand, it's setting us up for a more solid recovery when it happens. They're taking advantage of lower interest rates. They're refining. Their monthly payments aren't going up by much. In some cases, they're actually going down. They're getting ready. Another way to measure it is household debt obligations as a percent of disposable income. So basically, how much of your disposable income do you have to send out to pay for debt? And that number was nationally about almost 20%, and it's come down dramatically to barely above 15. It's come down so quickly. In just 2 or 3 years, it's brought us that ratio back to where it was in 1980. So suddenly households, again, have more disposable income. It doesn't mean they're going to spend it all and buy TV sets and go out to dinner and buy fancy cars necessarily, but again, it's setting us up for something where households will have more money to spend. This has been an aching, difficult process. It's been painful. Households have discharged debt and so on and so forth. They've defaulted. They've lost their homes. But the benefit of all this has been now there is, in fact, free cash flow available at a much higher percentage than there was just 3 or 4 years ago. I did not expect this to happen as fast as it has. It's been a pleasant surprise. It's one of the reasons why I think we're getting out of this recession, this slow growth. We're going to begin to get out of it, and we're doing better than other countries have who've suffered similar fates in this sort of balance sheet crash type situation. Another example of households repairing their balance sheet is deleveraging. It's pretty much done. Households ratcheted back. They didn't borrow on their credit cards very much. Up until recently, they didn't buy a lot of automobiles, and so on and so forth. The amount of credit in the economy actually was declining. Household debt was declining. I think that process is largely over. If you look at the numbers, it peaked out around $14 trillion. It fell to about $13 trillion. If you look historically, there's never been deleveraging going on in a recession or after a recession. This is really the first time. You look at the recession of 2000, the one of 90, the double dip of 80, even the 1-2 in the 70s. There was no sign of, it was maybe flat. Maybe it didn't increase, but it didn't go down. So seeing it go down is a real sea change, if you will, but it's pretty much over. So I think the household balance sheet side is now finally looking pretty good. And the last reason I'm optimistic on the balance sheet side and the household side is household net worth. House prices now going back up. They've gone anywhere up from 5, 6, 7, 8% over the last 12 months. On top of stock market improvements, the net worth of households is pretty much back to where it was before. The Federal Reserve keeps track of this. They release it quarterly, but we're almost back to where we were. So, they've been through trauma, they've been through shock, but among people who have stock and who have households, they're feeling pretty good. That doesn't help the lower class or the median so much, or the below median households and so on, but the upper half certainly feeling pretty good. So on the household side, I'm feeling good. Banks are in better shape financially as well. They may not be lending as much as we'd like them to lend, and there are a whole bunch of other reasons for that, but nonetheless, economically, they're in pretty decent shape. Their profit margins, their total profit's pretty good. Their margins are quite low, but their total profit's pretty good, and their core reserve ratios are pretty good. They're stable. They're in good financial shape. They can withstand a lot of stress testing, if you will. So that's a good thing. The next reason I'm very optimistic, and these are in order, I think this deleveraging is very, very important, and this households improving and banks improving is critically important. Without it, nothing really happens. The second reason I'm pretty optimistic is that housing. Housing is a percentage of GDP. is normally about 5% of GDP. So if you look at new home construction and multifamily construction, be it rental or condos or whatever it is, broker commissions and so on, if you look at all that stuff, historically it's about 5.25%, maybe 5.5% of GDP. It fell precipitously to about 2.5% of GDP, and that includes renovations, alterations, and repairs. So that's partially, in large measure, why it was as high as it was, even though it fell by more than 50%. But now this is turning around, and there's a lot of leg room for this expansion in housing to move forward. You know, we came down precipitously. We were building about 2 million at a seasonally adjusted rate, annualized rate of about 2 million, little more than 2 million, and it declined precipitously to about 500,000, a decline of roughly 3/4. I'm not saying it's going to return to 2 million, but we're in for the next several years, 3 or 4 years, of reasonably very solid growth in housing. The multifamily sector declined and hit a bottom of about 70,000 units annually adjusted, and now has roared back dramatically to about 400,000 just last week. That was the announcement, and total housing starts last month peaked over 1 million, hit over 1 million, in large part or almost exclusively because of massive improvements in multifam, now at 400,000. So they're roughly 40% of all construction activities multifam. Conversely, single fam is at 600,000. It's making progress. It's up from the bottom, but it hasn't improved nearly as much. So going forward, I would expect to see more activity on the single fam side going forward than I would on the multifam. The multifam, of course, increased dramatically because a lot of people lost their houses, their FICO scores got trashed because of all kinds of job losses and household losses and so on. Parents or grandparents don't have down payments to give children or grandchildren, and so on and so forth. So because of stress in households, or historic stress in households, there's been a lot of movement to multifamily, and there's been movement to rental as well. So that's why the multifam sector's improved. But you look at the data on multifam and you say, this party, I think, is sort of nearing its end. There's still certainly time to build and develop and sell or lease up multifam structures, but given the tremendous improvement from about 60 or 70,000 units annually to now roughly 400,000, this 400,000 level we're at now exceeds the historic average of the last 15 years for about 320, 330,000 units. So I think single fam going forward will probably be adding in the ballpark of 20% units, 20% number of units per year. So we will be adding 150, 200,000 units every year in total housing construction activity. We're at 1 million, 1.2 million, 1.4 million, 1.6 million, and probably peaking out around 1.7 million or so in 3 or 4 years, with the predominantly being single fam going forward. This year, still multifam and single fam contributing, but after that, I would think single fam being much more important because multifam will have reached its absorption level, for the short near-term absorption level. The next reason I'm pretty optimistic about things being pretty good is corporate profits. They're really quite spectacular. U.S. companies have become very lean and very mean. They're very organized. They have figured out how to wring profits from all kinds of sectors. This has caused large profits and stock market performance of doing really, really well. The Dow Jones and the S&P and all these indices are very, very high. They're back to their heights of 07 and then the 2000 and so on, a little bit higher actually. And even though GDP growth from the last peak to now hasn't increased all that much, 6-7 percentage points or so, corporate profits are much higher. And this is giving people who own stock, either directly or indirectly through a 401k or a pension plan or something along those lines, we're feeling a little happier. There's a wealth effect that goes on. So this is all setting the table, if you will, for people feeling a little happier. There's nothing, in here that's explosive that's going to tell us we're going to have 3.5% growth going forward for the rest of the year. We're not. It'll probably remain sluggish. We're probably looking at barely sub 2% growth for the next couple of quarters. Maybe the last quarter we're above 2.2. We had a good first quarter at about 2.8 or maybe even 3%. It'll come out this week. So this year, again, unfortunately, remains a little sluggish. But you see under the covers things are improving. So this is all These are all pretty good signs. Another important thing I want to talk about is inflation. There's this big concern of, is inflation going to be there? Do we have inflation? When is it going to rear its ugly head? And so on and so forth. And there's really no evidence of inflation. You can look at it just about any way you want. You can look at the CPI. You can look at the trimmed CPI. You can look at the personal consumption expenditures. You can look at with energy and with food, or without energy and without food. You can look at a moving average. It doesn't really matter how you look at it, but in all these measures of inflation are dramatically below the peak levels that the Federal Reserve would start, alarm bells would start registering. So there's no need for the Fed to stop its policies. The policies will continue because inflation is low, well below 2.5% or so, and unemployment is well above 6.5%. So there's no expectation that they will stop their policies. So in the low inflation, on one hand, we'd like to see a more rapid growth in the economy, which might increase inflation. But the good side of the slower growth that we're going to be experiencing the rest of the year is that inflation is going to be very tame, and the Fed will be able to continue to increase its balance sheet and put dramatic or maintain downward pressure on interest rates, which should encourage home construction activity and so on and so forth. The last reason I'm feeling pretty good is people are beginning to ask now, we haven't had a recession in a bunch of years. The recession officially ended in the middle of '09. That's almost now 4 years ago. While we may not feel like we've been enjoying a recovery, we have been. GDP's going up, employment's rising, and so on and so forth. So when's the next recession? And I did some work and looked around and tried to make some extrapolations on what if the Federal Reserve began to tighten, or what if this, or what if that. And there are a couple different measures you can look at. But in every single case, the consensus, the conclusions are there's not a chance of a recession occurring. I mean, unless fiscal policy and monetary policy become crazy insane, and they do really stupid things. But short of that, I don't see a recession happening for a minimum of 3 or 4 years. I mean, something could happen, terrorist strike or 9/11 or God forbid, something like that. But short of that, easily, there's nothing in the cards, and there's no expectation something will come into the cards economically that would cause us to go there. So we've got a good long time to get our ship in order, to get housing starts up. Inflation remains benign. Households are improving their financial situation. There's a lot of good news out there. Unfortunately, part of the reason we're not having such robust economic growth, and I think this is important, is there are a lot of headwinds out there. The fiscal headwinds that we're facing are quite serious, interestingly enough. Congress has largely solved our budget problems over the last several years, 2 years or so, starting in the middle of 2011 or early 2011, and then the summer 11 fiasco with our debt ceiling crisis, followed by the fiscal cliff about 3 months ago and sequestration just a month ago, a little more than a month ago. Collectively, along with a growing economy, increased tax revenues, and decreased social spending on food stamps, unemployment insurance, and so on, has dramatically changed our budget situation. So the budget situation has gone from a case where we had a budget deficit at the worst in 2009 of about 10% of GDP. It's now rapidly declining, and by the end of next year, may well be no worse than 3% of GDP, or 3.5%, or certainly by 15, no worse than 3 or 3.5% of GDP, which is pretty much a sustainable level. So that's a 7% swing in the budget deficit size. Changes in the budget deficit of that magnitude pretty much only occur either after wars or end up causing recessions. So the fact that we're not in a recession despite this massive fiscal stimulus is a tribute to our economy and our resiliency. And absent this, our economy probably would be growing 1% faster. Now, this is a question of fiscal austerity and budget spending and deficits and generational issues and grandchildren, and I get that. But the point is, looking at our GDP in isolation without appreciating the large fiscal headwinds that we're facing is it doing a disservice to the economy. So I think the underlying strength here is pretty good. This is not a stimulus. This is not an economy roaring on steroids on the fiscal policy side. It is benefiting tremendously on the monetary side from low interest rates, from what the Fed is doing in the purchasing of $85 billion a month. So all in all, looking forward to this coming year, I see multifamily starts increasing, not by as much as they have been. I see single-family starts improving nicely, by well over 100,000, maybe 150,000. probably something along that lines, and that continuing for the foreseeable future, with single-fam starts probably getting a little bit better and growing by 15 or 20% consistently over the next 3 or 4 or 5 years. Our budget deficit slowly goes away. Inflation's quite benign. Corporate profits look pretty decent. The stock market looks reasonably priced. And households are fixing themselves up, and I think that's really one of the most important things going on that we haven't fully appreciated, and that is setting us up, hopefully, for a 2014 that shows us a little bit more growth.